Hello guys, what is happening and welcome back to the channel. So in today's video we are talking about the two banks that could be most affected from contagion from the property bubble collapsing in China. So without further ado guys, let's do this. Alright guys, welcome back. So today we are discussing the two banks that may be most exposed here in Canada to the property bubble collapse in China and the contagion effects which will come to not just Canada but many other countries, and Canada is at the highest risk of a banking crisis. Now, if you haven't seen my video about how Canada is at highest risk of a banking crisis, then go and check out that video. Check it out, see what you think, and then also check out the video I did which is about the banks and their leverage ratios. Again, that is quite important. So let's get into this guys. So first thing I'm going to throw up on your screen is a Wikipedia. We are looking at the banks that operate in China, some of the global banks. So I'm going to throw up on your screen now some of the Canadian banks that are operating in China. Now let's have a look. Oh, look who we've got on that list. Scotiabank. So Scotiabank is on there, and there's loads of other banks. Standard Chartered Bank from the United Kingdom. You've got Japanese banks, banks from Australia and the US, JP Morgan and Chase Bank also operating in China as a subsidiary. And then we're also going to go down a little bit and you can see Bank of Montreal is also there. Now, I've already raised red flags about Bank of Montreal and Scotiabank in my other video, but this just further concludes that these banks are operating on thin ice right now, because we're about to look at some of the major things which, I mean, are just quite frankly on their website. They don't hide these things. They're right there for us to see what they're doing. So let's take a look at that. Scotiabank has been in mainland China for more than 30 years, beginning with the opening of a representative office in Beijing. We also have two branches in Shanghai and Guangzhou, I think that's called, covering major markets throughout the country, as well as an equity investment in the Bank of Xi and a wealth management joint venture with the Bank of Beijing. We provide a wide range of products and services. So we're about to look at these products and services. So let's throw that up on the screen. You can see there we provide a range of products and services to business customers in China. What do they provide? Local currency loans, other currency loans. Those are the ones we're most concerned about. Because if they're providing loans, let's face it guys, real estate is 29% of China's GDP. If they are providing loans, that means they are involved in the real estate industry, whether they like it or not. And this has been a major cash cow for a while. And you can actually look on BMO's website for China, and it even details how they've expanded their operations throughout the past 6 years massively. So let's dig into BMO now. So on BMO's website, you can see there corporate lending. Foreign and local companies in China benefit from our ability to offer RMB loans and deposits. Our RMB lending capability is especially important as China does not currently allow conversion of foreign currency loans into RMB proceeds. Our specialists in North America and China can help with all the necessary information for your RMB loan. So they are loaning money out as well, guys. So when you think about contagion of the property market collapsing in China and the financial crisis that is about to ensue, then you have to think, how exposed are we? Well, the fact is we're very exposed because we've got two of the biggest banks in the country that are operating within China. Now, the thing is, this whole thing that I'm talking about with Evergrande, Fantasia, all these developers is just the beginning. It's just the beginning of a GFC 2.0. And the thing is with this GFC, the Global Financial Crisis 2, which is coming to a screen near you. Sorry, I couldn't resist that. The thing is with this, it is much, much bigger than the GFC was, and we are much, much more leveraged, as you're going to see in my next video, which I'm going to do, which is about GDP and debt, that we are totally exposed, whereas back in 2008, we were not really exposed here in Canada. Right now, we are one of the most exposed countries in the world, because if there's a liquidity crisis that occurs that is looking highly probable, it could lead to a banking crisis, but not only that, it leads to debt deleveraging. That's exactly what happened in 2008, is you saw massive deleveraging of both consumers, businesses, and it had massive ramifications. And even though the Fed stepped in and they brought rates down to nothing and they started up quantitative easing, the economy did not recover. Certain asset classes did not recover for a long, long time. And the worrying thing is, as you're going to see in the next video that I do, which is about debt to GDP, we're going to draw some interesting comparisons between what's happening here in Canada and what was happening in the States during 2008. But the thing I want you to understand is what's happening in China is exactly the same thing, and it's under the same circumstances as what happened in the United States. But it's much, much larger than that bubble, and it's going to trigger something which is much, much bigger and affects the world much more globally than the US recession is. Because China is a big producer of goods, and if loans are hard to come by because there is debt deleveraging, then that means China is not going to be producing as many goods. That means goods are going to go up in price, and that further puts pressures on inflation and everything like that. And it becomes a very sticky situation that it puts central banks in, which they've been in before. They have to raise rates despite the economy is not doing well. And this is exactly what happened during the late 70s. Rates went up to 21, 24% in some countries, and it saw a massive debt deleveraging. And the thing is, it was hurting people. Those interest rates were really hurting people. People don't realize that. They don't seem to look far enough back in the past and draw comparisons. They always say, this time is different. We will be okay this time. We've got our dear leader in charge. The central bankers are really, really smart. And how smart have they been? Let's be honest. Because I've been saying it's going to be 5% inflation since April. Yet they've been saying it's going to be transitory since April. And once again, it's beginning to pick up momentum. Inflation is once again building. So the thing is, guys, final thoughts on this video are, if you have money in BMO and Scotiabank, then I would seriously consider moving it to a different bank. This isn't financial advice. Do your own research. I'm not a financial advisor. That's just my opinion. If I had money in Scotiabank or BMO, I would be taking it out, putting it in another bank that isn't so exposed to what's going on in China. But that brings me on to another point, is that a lot of the other banks are just as exposed to China as Scotiabank and BMO. So how protected can you really get? Because the fact is, BMO packages and sells so much CMBS and RMBS securities that it's a major problem if China's housing market goes down, and they have spread the garbage throughout the banking system in Canada. So anyway, guys, I thank you so much for watching. I hope this video was insightful for you, and I hope you enjoyed it. If you haven't done so already, guys, please sign up to my free monthly newsletter. It's absolutely free, and the email is below right now, traderls2021@gmail.com. Anyway, guys, thank you so much for watching this video. Thank you to all the new subscribers. Thank you to all the current subscribers. Thank you to all the people that keep smashing that like button to get these videos out there. And I will see you in the next video. As usual, keep